Okay, if you've never heard of a guy named Greg Foss, I really like Greg Foss. He's a Canadian fellow that worked down on Bay Street for years as a some sort of capacity in credit finance, and he said something about an asymmetrical opportunity in Bitcoin. This is not about Bitcoin, but just the philosophy, the idea. And what he said was, when presented with something that's a guaranteed, failure or a guaranteed success, you have to do something about it. And he was referring to an asymmetrical trade with Bitcoin. But I say the same thing about these currency. Okay. Knowing that currency is constantly losing value. And I mean, if you haven't figured that one out yet, then maybe this video isn't for you, or you're going to have to get up to speed on some things. But currency, you can just track its history. It loses value constantly. It's just baked into the way currency works. And I've done a number of talks on that I won't belabor it. But knowing that currency always devalues, you have to do something about that. It simply cannot hold on to currency in order to save for the future. Currency only has value currently, and that means it has value now, but it cannot preserve that value over time. So knowing that, you simply cannot just hold on to currency as a savings vehicle anymore. You can't just leave dollars in the bank or cash in a box and leave that for the future. You're going to come up tremendously short. And because this problem exists in infinity constantly, it constantly works the same way, and it operates behind the scenes. You really don't have a way to measure it or detect it, other than when you extract those dollars down the road and go to use them to buy something, you find out it's going to take a lot more than it used to, and thus the problem with currency. So knowing that, you simply have to address it. And that's important to what I'm going to talk about here, because I'm going to talk about something no bullion dealer will ever tell you. Now, I get this question relatively often. People that are relatively new will come in and they'll say, okay, if I buy this gold bar, the silver bar from you today and sell it back to you tomorrow, how much will that cost me? How much will I lose? Because they've done a bit of research and they realize there's a premium on buying gold and silver. Now, yes, there's a premium on buying gold and silver. Simply look at the spot price, look at the retail price. The difference is your premium, because typically when you buy it at a retail price. And when you sell it, it'll be bought back at the wholesale, or what we call the spot price typically. Okay, so knowing that, it's a simple, easy calculation. Now, I've literally had people, when they realize that, said, I just can't do this. And I would say, why? And they, well, that's just too much of a cost. Is it? Okay, let's examine that. We're talking here about assets. Now, if you go back and watch the trailer channel video, multiple assets is the key. Go to you're already on my YouTube channel. You go back to the channel, you click on the Durham Precious Metals logo down in there or something in the description, and you go back to the channel, there's a channel trailer that'll start to play immediately. It's automatic. Now, and in there I talk about multiple different assets and why. That whole multiple different assets to do with their dynamics, and it's a value strategy for the average person. And it's something you're going to have to work out on your own. I can't tell you how to do it, and I don't know your situation and don't have the qualifications to tell you how to do it anyway. But I can point out to you the dynamics, some of the pitfalls, and some of my ideas so that you can work on that. So that's kind of the beginning thesis of what I'm going to expand upon here. So I get this question, how much, what's the premium, the difference, and how much are you going to sell? Now, first of all, I get the point of the question. It's a hypothetical question. Nobody's going to buy it and sell it back the next day. You probably shouldn't sell it back the next year either. I mean, my philosophy, just not financial advice, but my philosophy is that an investment should be considered long-term, unless, of course, you have a short-term strategy. I have friends that swing trade and day trade and do stuff like that. They have a short-term strategy. They know what they're doing. They're professionals at it. And in those regards, long-term is not the objective. They're looking to make small profits on short trades. That's different. If you're good at that or want to learn that and want to experiment with that, that's fine. But for most investing, for most retail investors, people that have jobs that don't have time to deep dive into all kinds of complex calculations and theories and charts and tracking this and tracking that and watching 6 screens all night. Yeah, other people that do that probably, and there are probably some people that are pretty good at it, but is that what the average person wants? No. So we need to be able to diversify our asset base without getting hammered by inflation or market forces, and be able to make choices within the allocation of those different assets, and so that we come out better off than we started in. So again, to review, dollars constantly lose value, so you have to address that. You can't just leave money in the bank. You can't just leave it in a shoebox. You can't leave currency, not money, in a shoebox or currency in the bank. It's going to devalue silently, quietly, while you whittle away your time, and you're going to come up short later on. So you have to preserve that dollar value in assets. And we believe obviously in gold and silver, but I mean, that's just what we do. So premiums as well are a stumbling block for people. So here's the thing, the conversation I have with everybody about this, to try to rationalize it. And I don't mean rationalize it in a negative way, like, oh, you're just rationalizing. No, but I mean, there's such a thing as rationalizing and understanding something so that you can come to terms with it and realize, whether it's a good or a bad thing. And in this case, it's a good thing. So the premiums typically on gold and silver are somewhere between 15 and 25% right now, which seems like a lot. But in reality, everything has a premium. We just don't call it a premium. We call premiums on gold and silver because gold and silver are considered insurance, and insurance has premiums. A bond has a coupon rate. They have different terminology for what it pays or what its costs are. So being that gold and silver have that premium, people feel like, well, okay, if I buy a silver maple at $40, then I have to wait till the spot price is at least $40 to gain some dollars so that I can make a profit on the silver that I bought. Now that sounds reasonable. And in some cases, if you think long-term, it will work that way. And there's nothing really wrong with that. But in a sense, it's a wrong-headed approach. And I'll try my best to explain why. This gets a little heady and complicated, so pay attention. But it's really important people understand this. I'm probably going to lose some potential customers over this because they're going to go, oh my God, they're going to shut the video off right now and say, no, I just can't accept that. I've literally had people say, I can't accept that and not buy precious metals. No matter how much you explain to some people, they just have their own view on it. And they simply look at new numbers, and numbers mean everything to them. And I'm not saying numbers are not important in this, but it's about comparative numbers. Again, I always state this. So there's going to be, a time that'll have to pass for that to happen. And there's nothing wrong with that. But keep in mind that currency losing value, let's say that's a 3-year period and you're in a 20% inflationary environment. If you went from, $40 retail and then later on what was this $41 spot, and you feel like, well, I made $1 on that maple. Again, if you take those dollars at that time, 3 years hence, that have been exposed to inflation, and because dollars always lose value over time consistently, you're going to find that you're still coming up short. You should say, well, why am I doing this? Well, that goes back to the first reasoning, which is because we know this is guaranteed to lose. So if something that's guaranteed to lose, you have to address that and take this capital and put it somewhere where it may gain, has a possibility to gain. The question is how much gain do we have to outrun inflation? You may never, ever, this is the real downside of all this, because nobody can tell you what the exact inflation rate is for you. It's going to be a very difficult calculation. You're going to have to take, the basket of everything you buy and track that for years and find out, okay, what was my mortgage, my food, my gas, my everything. And most people won't go through that exercise, but suffice it to say, your inflation rate is your inflation rate. And the CPI can't tell you that. It's a ballpark indice for big business and governments to, make grandiose calculations and different things like that. But the real inflation rate for the average individual is always going to be a lot higher than that, because our expenditures are balanced a different way than big businesses. So it's never going to be absolutely accurate. Most people's inflation rate, as I've said, is probably pushing around 20% a year for the last 3 years. So you're probably not going to see silver keep up with that. Again, it's the guy who loses the least wins. This is another thesis of mine. And this is, not something that people want to hear, but you have to realize the landscape and the game that you're playing if you're going to be successful at it. And you're going to have to make certain choices, whether they seem irrational or not, based on math. And the math doesn't lie if you do it right. So again, back to this idea of, buying it at, a certain premium and then having the spot price reach up to that premium beyond and cashing it in. Good, that's positive. But what you have to understand is the first premise again is that this is a liability. So if you're going to get out of metals and back into cash again, why? Right? You wanted to get out of cash because of the first premise, which is that it always loses value. Now you're back into cash. Now what? What is your plan for the silver and gold you buy? Now, I think a lot of people's plan is just to have more dollars. But again, we've already addressed the dollar factor here. You're buying an asset. Why buy an asset? If you just want to enjoy the dollars, go buy a boat, go buy another car, buy something you can enjoy, right? If you're just investing the dollars to create more dollars to buy stuff to enjoy, why bother with assets in the first place? I mean, most assets aren't going to inflate with the speed of the market anyway. You're going to make up some ground, like if there's 20% inflation, you make up 15% of that at least, and you only lose 5 over time. That's better than losing 20 or being in the negative and losing even more, not investing at all. So all of these things are factors, and only you can decide how they matter to you. But the math and the concepts, a lot of people don't really think about. So knowing that you're going to be able, going to buy gold, and it probably isn't necessarily going to keep up with inflation necessarily. Now what? Well, the point is that as you're following the price increase of your gold or your silver, you should also have your eye on other things like maybe your mortgage or other assets, loans that you have outstanding or that could be paid off and reduced interest, or other assets that you hold, like maybe land is out there. Different assets are going down in price while gold and silver is either holding ground and going up. And I've talked about this before. And this is what you should be looking at, so that when you're ready to divest of your gold or silver or both, that you can take that capital and put it somewhere else so it isn't exposed to this again, sitting around with dollars or just being frittered away on fun and opportunity. I'm not saying that you can't do that, and that isn't a legitimate thing to do if that's what you want. If you thought that silver was really going to take off and boom, or gold was really going to take off and boom, you were just going to get more dollars and you want to buy some to speculate, that's fine. But know the risks. Know the risk, because you're going to have to outrun that premium to get ahead of where you are, and then you have to take in and factor inflation over that time. Maybe if you're looking short term, you might be better just to hold on to your cash. If you just are thinking, I want to save up some money to buy a boat in a couple of years, probably better to just put the cash away than to invest it in something that has some downside risk, because every asset has some downside risk and some cost. So that's the big point, the big takeaway here is that every asset has a cost. Okay, so let's compare some asset costs. I said that gold and silver's premium is probably somewhere between 15 and 25%. Okay, which seems like a lot, but here's the thing. That premium is paid all up front. It's debt settlement. Gold and silver are debt settlement. Okay, this is not debt settlement. It's a debt instrument that keeps getting passed around and retains some of its debt status as it does that. This has been weighed in upon actually by Supreme Court judges in the U.S. Look at the judge's comments on the Stanek versus White case, and he'll talk about the nature of the debt still exists, even though you extinguished a debt by giving this to somebody. You owed your friend $20, you gave him $20, debt's extinguished. The nature of the debt still exists. It's a interesting. It's philosophically, it's the only way to look at it, because the math and the thought process behind that is mind-boggling if you look at it for too long. The nature of it still existing. It's almost like metaphysics. But anyway, beyond that, so different assets are going to perform on different timelines as well. So, I'm not a big fan of the speculative modality in gold and silver. So if you're thinking of doing it that way, just know what you're getting into. Now, I've said this before, and I'll say it again, that going forward now with the landscape of gold and silver and all of the mess behind that's going on behind the scenes and all the intrigue there, we do believe that gold and silver are going to have a massive breakout, and then they're signaling some of that now. So a chance to do speculative gains that can beat the market here in physical, possible. But you know, again, that is a risk. Everything has a risk because there's no guarantee in that. So for me, it's more about risk mitigation against this. Gold and silver are a chance to outrun the losses that currency, and knowing that that's baked in, they're a better bet. So for me, converting any excess currency I have to silver and gold are pretty much a straightaway for me. I go right to it. And there's not a lot of, I don't have to think about it much. Gold has beaten the S&P on returns for 20 years, past 20 years. And looks like the future is going to be even brighter. So I think it's a great bet for just about anybody. I've said that before. So the other issue then is looking at comparing, okay, so if you don't like the sound of the cost, the overcost, the premium on silver and gold, let's compare it to housing. Housing's super popular in Canada, and you know, tons of money have been made investing in real estate. And so I think it's the most important one to start with. So what is the actual premium on a house? Right? Never been asked that question before, but I ask that question a lot when people like stumble over premiums, and you can see them hesitating in the wheel string. They say, okay, what's the premium on your house? And they'll look at me and, okay, well, let's call it something else. What's the interest charge? And don't tell me it's 6%. That's another delusion, right? If $1 million home had a 6% mortgage, it's not $60,000 you pay for that mortgage. The average mortgage rate for the last 70 years, I've said this before, I went back and tracked the actual individual years, divided by 70, it's 6.6%. So it's 6.6% if you buy $1 million home. You don't pay $1 million for it, you pay $2.2 million for it. You pay $1.2 million in interest, approximately, somewhat less than that, but it's, for rounding off and rounding averages, it's $1.2 million on $1 million at 6.6% on a 30-year mortgage. Okay, which is a very common, and that is an average mortgage. I mean, everybody thinks interest rates are high right now, and that's all you hear. They're only relatively high to what they were, which is, I've called the mortgage twilight zone for years, and it was a very dumb thing to have super low interest rates. It just fuels bubbles, of which we're sitting on top of one of the biggest one in history. So I remain. So at 6.6%, you pay $1.2 million in interest on $1 million purchase. That's 120% premium. But see, you pay it in increments along with your mortgage payment. It's baked into each mortgage payment, right, through amortization. So you don't notice it. And most people are so starstruck by owning their home and all the wondrousness that comes with that. I get it. It's a great feeling. Walk into that new place and this is going to be ours and that's going to be my office. And it's a joyous occasion to have a home. And that's the reason to have a home. That is the great joy in a home. Shouldn't be about the dollars. I know, stepping on everybody's toes again. I'm sure I've pissed off a lot of people recently, and I'm going to keep pissing people off with this until it sinks in. That numerically, with a home, not a great investment, not your primary residence. Like, primary residence is not an investment, folks. If you think it is, well, think again. You'll have to work that out yourself or learn the hard way. It's a place to live, and you're going to need it as a place to live. My silver, I don't need to live in, so it has a different dynamic. It is truly an investment or a store of value, or whatever you want to call it. A stock is an investment, a second property is an investment, but your primary residence is not an investment, but you pay a heavy premium for it, as I just illustrated. And so comparing, 120% premium on your home to, average of 20% on gold and silver changes the landscape, doesn't it? Think about if you had a financial planner and you were to put those dollars into a fund. Like, some of those stocks can go to zero, or they can go down drastically. Gold and silver don't go down like that. They might go down a little bit in market cycles, but they don't go down to those degrees. They've never gone to zero because they're debt settlement. They're a real thing. Very difficult for real things to go down to zero in price. Paper promises can go to zero in price because of non-delivery. See, gold's already delivered. When you buy it, it gets delivered right into your hand, right, immediately. It's debt settlement, and it's both sides of that ledger on that transaction are settled. With a mortgage, there's nothing settled until the end, until you make your last payment. And so factoring all that in and factoring in all the additional cost owning a home, the, you know, the 1 to 3% rule, it takes about 1% of the value of the house annually to maintain and upkeep it. And you have tax and other maintenance and different things like that. A home is not a great investment numerically when it's all said and done, because right from the get-go, you're paying far more for it than the list price. You're paying 2.2 million for what you say paid $1 million for. So when someone asks you what you paid for your house, make sure you get the mortgage calculator out and forget what the sign said or what the paperwork said. That's what you actually pay for your house. So comparing it in those terms, you can see that that's a pretty big cost. Same with an auto loan. I'm going to put up a little chart on the screen here that actually shows how much an auto loan, like for a $100,000 auto loan, you're looking at approximately 35%. It's $35,000 on 100 on a typical auto loan for $100,000. And I think that sounds high, but just go out and buy a new pickup truck right now, a 2,500 or 50, even a 1,500 pickup truck right now. And you're going to see that at an 84-month loan, it's going to cost you about $135,000. So that's a 35% cost. Same with this, got sidetracked to talk about financial planners. If you have a financial planner for your investments, you know, some of those guys charge 2.5% trailer fees per year just to manage your digital boxes of assets. And if you do that over 30 years at 2.5%, that's, you know, let's not even bother with the compound. Just 30 times 2.5 is what, 75% just for someone to manage your portfolio. And that's not including losses on some of those assets or weak gains, right? And you got to factor all that in. So every asset has a cost associated with it. There's no getting around that. They all have a cost. It's just expressed differently and paid for differently. Gold and silver being debt settlement, you pay it all up front. And because of that, you notice it. It's obvious. It's so obvious people ask about it. I'm sure people don't even want to know to ask somebody that's on the other end of a mortgage calculator what they're actually paying. They'd probably rather not know, because I think instinctively people know that it's a lot. I mean, I've heard plenty of people say, yeah, you pay as much in interest as you do for the house. And yes, in a normal rate environment, you do. So I make this point not to beat up on other assets or pick on anybody for their choices. These are simply observations to help you rationalize, as I said, the purchase of gold and silver and to get around this premium, because the premium is obvious to people. They figure out very quickly, okay, I'm going to buy it at this rate, I'm going to sell it back at this rate. There's a loss there. I want to know what that is so I can feel okay about it, right? And rationalize it somehow. So there's your rationale. Every asset has a cost. There's no getting around it. And the most popular asset out there, your home, has the highest cost. It has the highest premium on the original purchase value. So there you go, folks. Now you hopefully have an understanding of that. And I hope that isn't too abrasive of a realization for you. And like I said, I know there's some people that are just going to go, whoop, and they're just going to reject that out of hand. But I would rather you know the truth, what you're getting into, because that is the most important asset you have, is the truth when it comes to your numbers and your finance. So hope that helps, folks. Thanks for listening. Have a great day.